Swipe, spend, repeat. The advent of credit cards and the rise of consumer debt. The culture of convenience in modern economies. The act of paying for goods and services has become almost frictionless. A quick tap, swipe, or click can secure everything from groceries to luxury vacations. At the heart of this seamless system is the credit card, ubiquitous, convenient, and powerful. But behind its polished surface lies a more complex story, one deeply intertwined with the evolution of consumer behavior, financial institutions, and socio-economic change. The credit card is more than a piece of plastic. It is a lens through which we can understand the rise of consumer debt in the post-war era, and how it continues to shape economic lives today. The birth of credit. Before the card, long before the first Visa or MasterCard, the concept of credit existed in various forms. Ancient civilizations such as Mesopotamia and Egypt practiced rudimentary lending, often based on relationships or barter. In medieval Europe, moneylenders and merchants kept paper ledgers, offering goods, on account, to trusted clients. The idea was simple. Take the product now, pay later. In the early 20th century, as industrialization expanded and urban centers grew, department stores and oil companies began issuing proprietary credit accounts to their best customers. These charge plates, or courtesy cards, weren't really credit cards as we know them. They could only be used at a single business and typically had to be paid off in full each month. Still, they marked a shift toward consumer financing as a tool for growth and loyalty. 1950. The birth of the modern credit card. The watershed moment came in 1950, with the launch of the Diners Club card, the first multi-purpose charge card. The story of Diners Club is the stuff of financial legend. Businessman Frank McNamara, dining out in New York City, realized he had forgotten his wallet. Embarrassed, he conceived a new kind of payment method that would allow people to eat and shop without cash. Within a year, Diners Club had over 10,000 members and was accepted at 28 restaurants. This innovation opened the door to a new kind of financial instrument, portable, universal, and untethered from any single merchant. American Express followed suit in 1958, targeting wealthy travelers. That same year, Bank of America introduced the Bank AmeriCard in California, which would later become Visa. Unlike Diners Club and Amex, which required full monthly payment, Bank AmeriCard allowed users to carry a balance, and charged interest on unpaid amounts. This key feature would soon revolutionize consumer spending. The democratization of debt. As credit cards evolved from elite status symbols into everyday financial tools, banks and card companies saw a new opportunity: scale. By the 1960s and 1970s, mass marketing campaigns targeted middle-class households, promoting the convenience, safety, and flexibility of credit cards. The strategy worked. In the 1980s, aggressive deregulation of the banking industry, coupled with innovations in data processing and risk modeling, helped credit card companies expand rapidly. They were now able to issue cards to millions of consumers, assess creditworthiness, and manage accounts with unprecedented efficiency. The ability to revolve credit, carrying a balance from month to month, became central to the business model. Interest rates could exceed 18 to 20%, and late fees generated billions in profits. For consumers, it was both a blessing and a trap. The rise of dual-income households, increasing consumer confidence, and a cultural shift toward instant gratification created fertile ground for the normalization of debt. Buying on credit was no longer a last resort, it became a lifestyle. The rise of consumer debt. A new normal. Between 1980 and 2000, total U.S. household debt tripled. Much of this was mortgage-related, but revolving credit, especially credit card debt, became a major component. By the early 2000s, Americans held more than $850 billion in credit card debt. The industry's profitability hinged on a paradox, encouraging consumers to spend beyond their means while penalizing them for doing so. A key feature of this era was the segmentation of risk. Card issuers learned to tailor credit offers based on behavioral data, rewarding transactors who paid off balances monthly, with perks, while profiting more heavily from revolvers who carried balances. Minimum payment structures were engineered to keep consumers paying interest for years, often without reducing the principal. For some, this meant manageable liquidity; for others, it led to a cycle of perpetual indebtedness. Credit cards also became a tool of survival for many lower-income households. As wages stagnated in the late 20th and early 21st centuries, and as costs for healthcare, education, and housing soared, credit often filled the gap. The plastic card in a wallet became both a security blanket and a silent burden. Crisis and regulation. The 2008 wake-up call. The global financial crisis of 2008 exposed the fragility of consumer finance. Although the subprime mortgage market bore the brunt of the collapse, credit card debt was part of the problem. As unemployment surged and asset values plummeted, millions of Americans defaulted on loans and maxed out their cards just to stay afloat. In response, the U.S. government enacted sweeping reforms. The Credit Card Act of 2009 introduced new protections, clearer disclosures, restrictions on interest rate hikes, limits on marketing to young consumers, and mandatory minimum payment warnings. While these reforms helped improve transparency, they didn't fundamentally alter the business model or eliminate the risk of debt traps. Digital age, digital debt. The 21st century credit landscape today. Credit cards are no longer just plastic rectangles. They are embedded in phones, apps, and e-commerce platforms. Fintech firms have entered the arena with sleek, digital-first credit offerings. Services like Apple Card, Klarna, and Affirm are reshaping how consumers access credit, sometimes bypassing traditional banking structures altogether. Simultaneously, buy now, pay later models are reviving installment-based lending, especially among younger consumers wary of high-interest debt. While marketed as smarter alternatives to credit cards, these services have begun to show signs of similar debt risks: overextension, missed payments, and unclear long-term costs. The gamification of finance, through rewards points, cashback, and curated financial dashboards, has created an environment where credit is not just normalized, but encouraged. Social media influencers tout luxury purchases and travel hacks funded by credit cards, contributing to a cultural ethos of "spend now, figure it out later." Psychological and social costs of debt. While the financial mechanics of credit cards are well documented, the psychological burden of debt is less visible. Studies consistently link credit card debt to elevated stress, anxiety, and depression. Unlike secured debt, such as a mortgage, revolving credit is often tied to everyday consumption, which can feel less justifiable and more shame-inducing when balances spiral out of control. Debt can also strain relationships, erode financial confidence, and limit future opportunities. Consumers with high credit card balances often face lower credit scores, higher borrowing costs, and barriers to homeownership or business creation. Credit cards, once symbols of empowerment, can become instruments of disempowerment when not accompanied by financial literacy and systemic support. A complicated inheritance. The credit card is a marvel of modern capitalism, a tool that offers access, flexibility, and convenience, while also extracting billions in interest from the very consumers it empowers. Its rise mirrors broader trends in American life: consumerism, individualism, financialization, and inequality. Understanding the advent of credit cards and the rise of consumer debt is not just a matter of economic history. It is a window into how we value time, risk, trust, and aspiration. As financial technology continues to evolve, the core question remains: will we build systems that serve human needs, or systems that human needs must struggle to serve?